All right, let's talk about this huge potential problem that we're facing because of both coronavirus and what the Saudis and Russians did with the oil prices. These two things fusing together are basically creating the perfect storm. And now we might see another 2008 financial crisis. That's how bad it could potentially be. But I'm going to explain all of it. You're going to understand what's going on by the end of this video. And I will say that this does get a little advanced. We're going to be going over the research straight from MacroOps, and it all has to do with credit markets, which a lot of us aren't as familiar with. But don't worry, stick with me. I'm going to try and explain it as simply as possible, and if you have any questions, just throw them down below, because I do my best, but sometimes I make no sense at all. But as long as you do your best, that's all that counts, which is what my mom told me. But okay, the big thing that we want to figure out is whether the current trouble that we're in is going to create larger trouble. Because the way all our global finances now are all connected, it's all like a house of cards almost, or like dominoes. So if you tip one domino over, a bunch more might fall, and you get cascading effects, which is what you're trying to analyze. So Mohammed El-Arian, who's a famous economist, he kind of explains where we are at right now in the credit markets. And this article is from MacroOps, as I said before. But first off, he explains that sudden sell-offs in the market like we just had, they have a way of exposing all the rot that's underneath, the market and economy. But because of that, there's a risk of amplifying that initial shock. So that drop might become a self-feeding cycle, which is those cascading domino effects I was talking about. So the first thing that happened with the coronavirus is that we're going to get a global economic slowdown, right? So yeah, that's crappy for companies that are trying to make profits by selling products, and then it goes and affects the rest of our economy. But it's especially bad for those companies that have a lot of debt, even if it's not necessarily bad debt. So in this case, it would be US investment grade corporate debt. But when the economy slows down and they're not making their sales, well, you know what could happen to that debt? Well, it can get downgraded. And a lot of this debt, if it gets downgraded, it goes into junk status, which is dangerous. And the reason again why debt could get downgraded is when the credit agencies don't think that company can pay off the debt, which happens if there's a global economic slowdown, right? So for the last 12 years, since like 2009, the banks have been pumping money into the system, right? We've had easy money, and because of that easy money, we've had a lot of financial leveraging. That means lots of companies taking on a lot of debt, and that has led to higher profits, and we've had a crazy bull market. But the problem when you take on debt, which you can call it operating leverage, is that it's a knife that can cut both ways, because come rain or shine, you got to pay off that debt, even if you're not making as many sales. So according to BlackRock, the US corporate bond market is over $10 trillion in size, which is 5 times larger than it was 2 decades ago. So when we have really low interest rates and all this easy liquidity, money being pumped in, the economy being held up by central banks, you get people taking on too much debt, people and companies. So like El-Arian says, corporate debt has risen significantly faster than earnings growth and cash balances, resulting in significant downward ratings migration, meaning that a lot of these companies took on too much debt, because it gets exciting, right? You could borrow all this money, make more money, you're making the payments, then you get too greedy and then take on too much. But the issue is that a lot of these companies have investment grade debt right now, right? But if they get downgraded because coronavirus made the economy so bad, they would turn into junk bonds. And when that happens to a company, you can call them a fallen angel, because they fall in from investment grade to junk. And here's the issue with getting downgraded, because a lot of the people that are holding this debt, the investment grade debt that basically lent the money to these corporations, well, they have different mandates and regulations that say they can't legally own high yield debt or, junk debt. So it's just like, think about a pension fund. A pension fund, say it's the firefighters pension fund from billions. If you watch those episodes, you saw how they couldn't invest in certain things because, well, they have fiduciary responsibility. They have all these regulations. They can't be too risky because they're holding all these people's pensions and retirements. They're looking for a more conservative return. So legally, they aren't allowed to get into some investments, including this high yield junk bond debt, even if it's the same company. Like the same company was rated investment grade here, and if they get downgraded and fall, all of a sudden these guys can't hold their debt. So if that happens, that would create large force selling in the market, which would create a feedback loop, right? Because if everyone's selling the debt, then more debt will get downgraded and there'll be a liquidity crunch. So again, here we're talking about like the second domino to fall. First domino might be coronavirus. Second domino is this high yield debt market. But guess what? These credit markets, they're not, independent of each other. So if you start getting a squeeze in the junk bond market, that's going to affect all the other credit markets. It starts affecting banks and what businesses can borrow, what people can borrow. And when borrowing can't happen in a credit economy, which is what all of us have across the world, then you get a crazy 2008 style scenario. And this potential credit collapse is why the markets are acting so crazy right now with the uncertainty around the coronavirus. The first level is, yeah, companies make less profits, there's less people working, economy slows down. Second level is the effect that it has on all this debt. And by the way, in all this volatility, there's still opportunity to get into some short-term plays. The explosive stocks checklist will help you with that because it gives you the 10 factors that our team goes over to find stocks like that. Stocks that can explode real quick and you can get out before they turn around. Really, shorter term trading is the best bet in this type of market. But there's a link down below in the description and comments. You can go check that out. Free checklist. But now let's move on to the second big factor that's going on. I said there were two, right? There's the coronavirus and then there's also this whole oil thing. So last week, the price of crude oil finished at $41.28. And keep in mind that the average break-even price for a US fracker who's, pulling oil out of the ground, it's $50 per barrel. So if they're still pulling oil out of the ground right now, they're losing because the price is only $41 per barrel. Now, this was the end of last week. And the reason prices were falling is because we were facing the largest commodity demand shock since 2008. So because China shut down because of the coronavirus, there's an estimated 4 million barrels per day of lost oil demand compared to 5 million barrels per day during the Great Recession in 2008 and 2009. So there's less activity, less people doing stuff, less demand for oil, right? And the demand drop from this coronavirus is almost as bad as what happened in 2008. And what happens if there's less demand for a good? The price of that good will come down to meet whatever demand there is. So that's why you saw prices of oil already dropping. But then on top of that, during last weekend, an oil price war started. The Russians and the Saudis basically went at it. Russia essentially pulled out of OPEC and the Saudis were arguing for further production cuts to match the decline in demand, but Russia said no. So because of their little breakup, Saudi Arabia announced that it plans to boost its oil output to well over 10 million barrels a day next month. So basically, these guys are gonna flood the market with oil. So demand was already low because of coronavirus, right? So the Saudis were like, let's cut supply so it can meet demand. But instead, Russia and the Saudis, they decided to get into a price war. So now they're gonna pump up supply. And what happens if there's too much of a good? The price drops, right? Because there's not enough demand to buy up all those goods. The price drops, right? Because there's not enough demand for that good. And that's exactly what's happening with oil, which is why we saw this ridiculous 30% drop in oil prices over the weekend. So think about it. We already have demand for oil dropping because of coronavirus. No one's going outside. No one's driving their cars in the most basic terms. Businesses are also slowing down. And then to add fuel to the fire, these guys are going to increase the supply. So it's going to drop prices even more. So like Alex says here, he cannot begin to even tell you what a big deal this is. The combined supply and demand shock, which is what I was just explaining, make oil under $30 a barrel not only a possibility, but a probability. And that's huge because remember what we said right here, the average break even for a US fracker is $50 a barrel. And if oil is selling for under $30, well, they're screwed. And now this goes back to what we were saying before about the debt markets, the investment grade US corporate debt. You know where a lot of that debt is? It's right with our oil companies in the US. They took on a bunch of debt to fuel all this fracking. US shale producers have a staggering $100 billion in debt and interest payments coming due over the next 6 years. And over 60% of that debt that matures over the next 4 years is speculative. And there's no way that these companies are going to be able to refinance and roll that debt over, not in an environment like the one we're facing where liquidity is going to dry up, easy money won't be around. And if they can't refinance that debt and they can't pay it off because oil is below $30 a gallon, then you're going to see wide scale defaults and companies going straight up bankrupt in the energy space. Russia, which is their plan, they just took a kill shot at US producers. Russia isn't stupid here, right? They saw the issue with coronavirus and prices going lower and they thought, hey, let's pile on and let's kill these US frackers. No one likes the US frackers because it made the US almost oil independent, which with Russia and Saudi Arabia, oil is the only thing they have. It's what keeps them in the game. You can't have other countries becoming independent. So Russia is willing to take the hit because they think they're going to survive, where these oil frackers in the US, they're not. See, Russia's estimate break-even price for oil is around $45, and the country has built up reserves over the last few years and can manage an extended price war. So it could be a straight up bloodbath in the oil space. And again, these credit markets, markets that aren't isolated on themselves. Like, who issued a lot of the debt for these frackers down in Texas and wherever? Local banks. So what happens when their books that are full of these loans all start defaulting? Then the bank gets screwed. Then the bank needs a bailout. And before you know it, you have a bunch of banks collapsing, just like in 2008. And if you think about Texas as being one of our strongest economies in the United States, what kind of hit is it going to take if all these oil companies collapse? This is what we're talking about when we're talking about cascading effects. Like Alex says here, lower oil prices certainly will benefit the American consumer, but the shock to the economy and the credit markets far outweigh the benefits of lower prices at the gas pump. The question is whether this will be enough to tip us over the edge and kickstart a feedback loop of liquidation. Everyone's selling everything. Or will the virus burn itself out in the next couple of months and the central banks stimulate enough and prop things up? Will that be enough to keep our whole credit system from locking up? And if that's the case, then we might have a massive bull market, but we don't know. That's why in the last video we were talking about how successful investing and like macro speculation, it involves looking at the probabilities of different scenarios playing out and then updating those probabilities as new information comes in and staying fallible. It's complicated, but it's got to be done. And if the oil space does blow up, there's going to be some incredible deals once the smoke clears. So Alex is looking for some fantastic companies in the space, but they got to have good balance sheets and incredible assets and strong free cash flow, which a lot of them don't. And they're definitely going to get beat up when the whole market tanks. So you're going to get a real good deal. In the next video, I'm going to go over a few oil names that might be great buying opportunities soon because of what's happening in the oil space. These companies are getting hammered. Subscribe if you want to see that next video. And if you're looking for tradable companies right now, then definitely check out this explosive stocks checklist because we give you the 10 factors that we look for, and these stocks should do pretty well in this volatility. Free checklist, link down below in the description and comments. And hopefully I explained this okay, what's going on with the credit markets and the risks that we're facing. But if you have any questions, just put them down below in the comments. Smash like if you liked the video, or even if you didn't, and subscribe so I will see you in the next one where we will continue this story. Stay fallible out there. Bye.